Berkshire's trillion-dollar playbook is not a secret stock list. It is actually a repeatable system, and in this video today, you are going to learn how to understand what you own, protect your cash, and decide where your next investing dollar should go. Today on 9 to 5 Investing, we are breaking down the 5 rules behind Berkshire Hathaway's trillion-dollar playbook. Then, we will look at what changed under Greg Abel, the new CEO of Berkshire Hathaway, what should stay the same, and what signals investors should look for next. By the end of the video, you will have a practical 5-rule scorecard that you can use to help make your next investment decision. Greg Abel became Berkshire Hathaway's new CEO on January 1st, 2026, while the legendary Warren Buffett stayed on as chairman. This transition is the first real test about whether Berkshire Hathaway's trillion-dollar playbook can outlast its legendary architect. For retail investors, the value is not in trying to copy Berkshire Hathaway's size or its private deal access. The value is in learning those 5 repeatable rules that have made Berkshire Hathaway so successful and applying them to your own portfolio. The official filing makes the responsibility clear. Abel is now responsible for Berkshire Hathaway's major investment and capital allocation decisions. Buffett remains chairman. Abel brought 33 years of experience running Berkshire Energy and about 8 years running the non-insurance Berkshire Hathaway businesses. This is an operator taking control of the capital engine that is Berkshire Hathaway, not a celebrity apprenticeship. Why should a retail investor care? Your portfolio is smaller, but your job is similar. Understand where the best combination between understandable risk and potential reward lies. Berkshire does not run like a normal conglomerate. Its subsidiaries are managed on an unusually decentralized basis. There are a few centralized functions. Local managers actually run the business, while the CEO focuses on risk management, capital allocation, management quality, and culture. A retail investor can copy the principle without copying Berkshire's structure. Let company management run the business, but keep your own rules for valuation, position size, and risk in one written process. The advantage is a repeatable system, not perfect predictions. Rule number 1 is know what you can know. Buffett calls this staying inside of your circle of competence. The important part is not how large your circle is. The important part is actually knowing your boundary. For a retail investor, this does not mean you need an opinion on every stock, sector, or market headline. Start by naming 3 to 5 business models or industries that you understand best. Write down what drives revenues, margins, and reinvestments. If you cannot explain how the company is making money, then you keep researching or you pass. Your ability to say no is an advantage. You never have to own a particular stock. Rule number 2, make your liquidity a weapon. At the end of 2025, Berkshire's insurance and other businesses actually held about $369 billion in cash equivalents and U.S. Treasury bills. The retail investor lesson here is not to sit on cash forever. The lesson is to avoid becoming a forced seller when the markets suddenly fall. Keep emergency savings separate from the money that you can keep invested for the long term. Be careful with margin or other types of leverage that can force a sale at the worst time. If you keep investment cash available, give it a rule and a purpose before that opportunity arrives. Holding cash is not automatically a return strategy. It is financial flexibility when it supports a written plan. Rule number 3 is to buy businesses, not ticker symbols. Berkshire's owner mindset treats a piece of stock as a productive enterprise. For a retail investor, a brokerage app makes the price of a stock impossible to miss, but the underlying business is what is really creating the long-term value. Ask yourself how the company earns money, where does the cash go, and does each retained dollar create value? Write your thesis in plain English before you buy. Then track a small set of business measures, such as free cash flow, return on equity, reinvestment opportunities, and debt. The quote on your screen is useful information. It is not the asset that you own. Rule number 4 is to make every dollar compete. Abel's hardest job is not running the subsidiaries from Omaha. It is deciding where Berkshire's next dollar earns the best risk-adjusted return. The choices include reinvesting in operations, buying an entirely new business, buying public equities, buying back shares of Berkshire Hathaway, or just simply waiting. A retail investor faces a very similar decision decision every time that paycheck, bonus, stock sale proceeds, or dividends hit their account. Compare the decision to buy a new stock with adding to your best understood holding, paying down expensive debt, adding to maybe like a mutual fund or an index fund, or just simply holding cash. Do not simply buy because a ticker is popular.
You look familiar. I know you, don't I?
The next investing dollar should go to where your expected return reasonably justifies the risk outlined in your plan. Rule number 5 is to build the process before the pressure hits. Berkshire discussed succession for years. Abel ran Berkshire Hathaway Energy, then oversaw non-insurance operations from 2018 to 2025. The board was not searching for a replacement during an emergency or a crisis. It was preparing a system in advance. Retail investors can emulate that same mindset by writing out rules for buying, selling, position sizing, and rebalancing before that volatility hits. You can keep a short decision journal that can outline what your thesis was and what actually happened. Automate routine contributions when it fits with your plan, and write out what would make you decide to pause or rebalance. Document the account structure and basic process in case you ever need someone to help you manage it. A durable investing process protects you from making every decision from scratch when you're under stress, when that crisis hits, when we have the Great Recession, when we have the COVID crash. You already want to have that plan so you can make the best decisions possible. Now separate what changes from what should not change. Greg Abel is an operator, not a Buffett impersonator. Communication may become less theatrical. Capital may tilt towards operating businesses that Abel knows deeply, and execution will matter more than annual meeting mythology. Retail investors should not judge the transition by whether or not Abel sounds like Warren Buffett or Berkshire Hathaway is winning every single quarter. Watch whether those core principles endure. Decentralized management, a very conservative balance sheet, reputation over quick wins, and a very long clock. The Abel era now has 3 practical tests. The first test is capital discipline. Can Abel say no, then say yes when the time is right? Second, test manager quality. Can Berkshire Hathaway retain autonomy while replacing managers across hundreds of businesses? The third test is candid communication. Will shareholders understand how Abel thinks about risk, returns, and mistakes? A retail investor can follow these tests through annual reports, shareholder letters, major transactions, and management's explanations without needing insider information. Ignore the weekly stock chart and watch those free operating signals over time. Before your next stock purchase, run this 5-rule scorecard. 1. I understand how the business makes money. 2. I can survive in a bad market without selling for the wrong reason. 3. I own the business, not the price quote. 4. Every new dollar invested must beat out its alternative uses. 5. My written process still works when emotions rise. If you cannot answer yes, treat that answer as a research assignment or a good reason to wait. The point is not to invest like a billionaire or predict whether or not Greg Abel will be able to carry on Warren Buffett's legacy and outstanding record. The useful lesson for a retail investor is much simpler. Investing becomes much more durable when you have a personable, repeatable system. Know your circle, protect your liquidity, think like an owner, allocate without ego, and build a system that will survive intense pressure and market downturns. These principles can support a portfolio built around individual stock, diversified funds, or a combination of both. Which of these 5 rules is missing from your personal process? Let me know in the comments, and if you found value in this video, please consider subscribing to 9 to 5 Investing.